Welcome, everyone, to the Information's TITV. My name is Akash Pasricha. It is Thursday, February 19th. Today on the show, the Information has exclusive reporting that OpenAI is finalizing its first commitments for a massive $100 billion funding round. We'll speak with our OpenAI reporter who broke that story. We also have more exclusive reporting on renewed momentum in the consumer IPO market, including Hungryroot, the grocery delivery app preparing for a public offering that could come as soon as this year. We'll then zoom out to the broader IPO landscape. We'll talk AI, space, and consumer IPOs with Renaissance Capital. We'll break down how AMD is taking a page from NVIDIA's playbook, acting as a financial backstop for Crusoe. And we'll wrap with a segment with our sponsor, PwC. Amid the so-called SaaS apocalypse, we are asking the question on Silicon Valley's mind right now: what does the future of software look like in the era of AI? It's a big show, so let's get right on into it. OpenAI is finalizing first commitments from investors for its massive $100 billion funding round. This comes as the company continues to need enormous capital to fund the build-out of its AI products and data centers. Joining me now to break it all down is Sri Muppidi, our OpenAI and Anthropic reporter. Sri, welcome back to the show. It's great to have you here.
Excited to be here.
What do we know about the current state of OpenAI's funding round?
What we know is that OpenAI is finalizing its first set of commitments for its 100 billion plus round that it's raising. So this round, which we had previously broken back in December, is up to 100 billion, but potentially even more now. The round valuation is 730 billion pre-money. So if, for example, the 100 billion plus comes in, they'll put it back out to 830 plus in terms of a post-money valuation. And in terms of the strategics that are investing this initial slate of commitments, it is Amazon that can invest up to 50 billion. It is NVIDIA that is up to 30 billion, and then Microsoft in the low billions of dollars. And then of course, SoftBank, a large investor that had led the 40 billion plus round last year, is coming in for up to 30 billion. This 30 billion will be split over 3 installments of 10 billion over the course of the year.
Now, the strategic investors here, we've talked about it a little bit with you, but it's so interesting to me that they really make up the lion's share of this $100 billion commitment. And I almost wonder, to what extent could OpenAI raise all this capital without them? What do you make of the fact that they are front and center here?
It makes a lot of sense, especially because it's such a large round. I don't think there's been a private capital raise this big that these strategics who have huge pools of capital and balance sheets can actually invest in a company like OpenAI. It's not to say that other financial investors will not invest either. So after the slate of initial strategics committing, there will be actually other financial investors. So we actually reported that OpenAI, for example, is in talks to raise from existing investors such as Thrive Capital, Coastal Ventures, as well as Sequoia and others. So we'll potentially see that 100 billion plus even go up even further because of the strategic amounts that it could actually push it out even larger than what we had initially expected.
Now, one of the interesting parts of your story is you had some reporting on the deal structure as well. So you reported that investors will get preferred shares that would convert to common stock in an exit like an IPO, and they will also get a 1x liquidation preference. Explain to us what that means. And then the broader question I have for you is, did all these investors get what they want ultimately here? Is this a good deal for them?
This is a great deal. I think this is the purpose of the restructuring that happened last fall that we have been really closely following, where essentially we're turning OpenAI into a traditional structure that investors can get paid out from. And so these types of terms are very typical of like other companies. And so being able to have 1x liquidation preferences, that's a standard deal term that essentially promises investors that they'll get at least their money back in the event of a sale or a sale of a company. And then also the fact that it turns into common stock is also like really exciting for these investors that hope that the company will go public, which we have reporting on that could be as soon as the fourth quarter of this year. But what I found really interesting is that OpenAI is actually calling this a Series C, which when you kind of when I first saw it, I was struck by it because I was like a Series C. But it actually is interesting because they have only traditionally raised 3 rounds. Those rounds have just been huge. So, for example, this is the Series C, 100 billion. Series B was last year, which was roughly 41 billion, and then the first round, 6.6 billion was from 2024, and that's not including, for example, the Microsoft round. So when you actually count it up, it is a third round, a Series C, but it does not look like a traditional Series C company.
Yeah, well, I can already see all the startups that will come in saying, we're doing a C. We're doing an OpenAI sized Series C, though. I mean, that is certainly the way some of these rounds end up trending. Although this is a huge number, and it kind of leads me to the next question, which is I want to understand or remind ourselves of the financial situation that OpenAI is in right now and why they need to raise all this capital. What are the latest figures now in terms of revenue and how much cash they're burning?
So the latest figures we still have are from last summer. But what we know is based on company's announcements is that the company had crossed, or we had actually reported this, that the company had crossed 13 billion in revenue last year, so 2025. And then we had previously reported last summer that the company between 2025 to 2030 would spend actually $450 billion in terms of all the costs of training and running its models, as well as any backup servers that it needs. And so this makes sense in terms of why the company is setting out to raise 100 billion plus now, because they have so much spending to come still.
And you mentioned it could come as soon as the fourth quarter of this year, the IPO. Is there any discussion from the people that you're talking to about this round potentially giving them a little more wiggle room in terms of that timeline, or even pushing it out a little bit later?
Exactly. I think what I'm hearing from the folks that I'm talking to is that it's sort of this dual scenario where if, for example, the conditions are right, you can never predict when a company actually goes public because it is such a macro thing. The company's essentially preparing and laying the groundwork to go public as soon as the fourth quarter. But of course, this 100 billion plus round would allow them to have more runway so that they can time it exactly when they actually want to. And so it could go into 2027. I think it's just that the company is preparing the steps to do so, just because the process of going public, as we all know, is so difficult, and that you have to sort of make sure that you have all your ducks in a row.
Great. Well, Shri, I want to thank you for coming on. That is Shri Muppidi, our OpenAI and Anthropic reporter here at The Information. Speaking of IPOs, our e-commerce reporter Ann Gehan has exclusive reporting on the IPO plans for grocery startup Hungryroot. Her story out today also talks about how the consumer sector is faring as software stocks have plunged. I want to bring on Ann to share with us what we know. Ann, welcome back to the show. It's great to have you here.
Hi, Akash.
What is Hungryroot? I never heard of them.
Hungryroot is an online grocery delivery and meal planning service. So if you think back to like the Blue Apron and other kinds of meal kits that were popular around a decade ago, this is kind of an updated version of that. So it's not quite a meal kit. But it's an online service where you put in kind of all your dietary preferences, your health goals, what you like and don't like, and then Hungryroot comes up with a weekly menu for you, weekly recipes, and then they will also ship you the groceries. So it's kind of meal planning and grocery delivery all rolled into one.
So, am I living under a box here? Like, I mean, I have never heard of Hungryroot, and maybe you've used it because I know you're a loyal Instacart customer from what I remember. Have you used it?
I've tried it out before, and yeah, it's interesting. It's definitely a different experience than something like an Instacart, and it's interesting the way that they've structured the business very differently than an Instacart, where Instacart is kind of more for that like immediate. I ran out of milk or I ran out of eggs and I need it in a couple of hours. Hungry Roots pitch is that it's more replacing a meal prep session on Sunday or when you're sitting down to kind of plan out what your meals for the week are going to look
Okay,
like.
so closer to a Blue Apron kind of model then.
Right, and their pitch is that all of the user data that they have and their recommendation systems makes that whole process very easy to personalize it to exactly what you like.
So, how is the company doing financially? How big is the business even?
It's, to your point that you had never heard of it before, it's pretty large, for a company that maybe isn't on as many people's radars. They just reported that their 2025 revenue was $700 million, which is 55% growth from the year before. So it's a pretty decently sized business. And I spoke to their CEO, and he said that this brand awareness is one of their big goals for this year. So trying to get more customers and more shoppers to hear about them for the first time, to understand, how it could work for them, and also, yeah, kind of overcome this preconception that people might have that it's just another meal kit. Kind of explaining how and why they're different.
And so what did he say about the company's IPO plans, or what does your reporting tell us?
I reported that they're eyeing a potential IPO that could come as soon as this year, but they're not. There's no formal timeline or process yet. But I do think that they're a great example of kind of how the consumer narrative has changed, even just over the past couple of weeks. For the past couple of years, I've reported a lot about how consumer has just been this sector that's been kind of left for dead, both by VCs and investors in the private market, as well as investors in the public market as well. And there just hasn't really been a lot of appetite for consumer IPOs. It's really since 2020. 2020 and 2021 was the last kind of big consumer IPO wave that we saw with companies like Allbirds, Warby Parker, Rent the Runway. And part of the reason why we haven't seen consumer IPOs for the past couple of years is because, by and large, all of those companies, most of those companies from the last kind of vintage, haven't really performed very well. They really indexed on growing as quickly as possible and not on becoming profitable. And so when you're reporting to Wall Street quarter after quarter that you're not making any money, that's a pretty hard narrative to sell. So I think Hungryroot and some of these other companies that have been coming up more recently and getting to an IPO ready stage, they're fundamentally just much more high quality businesses than some of the companies that we saw the last time around.
Well, and this was a point that Brian Sugar, who we had on the show with you for a previous story that you did, he made this point that consumer companies traditionally haven't had great unit economics. That's been the reason
Right.
for their downfall. It seems like this newer crop of consumer companies, at least some of them, have learned their lesson. And so the crop of consumer companies coming to market are actually better businesses. Who are the other consumer names that you're watching for IPOs here?
Yeah, well, I mean, you just saw Once Upon a Farm, which is a kids snack brand. The actress Jennifer Garner was actually a co-founder of the brand, but that's a like healthy snack brand. They just went public a couple of weeks ago, and the shares have performed really well since then. So I think a lot of people are interpreting that as a good sign. There's a juice brand, Suja Life, that said they filed confidentially in the fall. So I think a lot of people are expecting them to potentially uh, go out soon, as well as Jersey Mike's, which is a sandwich chain.
Good old Jersey Mike's.
Yes, Blackstone acquired them last year. And it's interesting that they reportedly are already eyeing an IPO. I think just in contrast to a lot of the software investments that private equity firms have made over the past couple of years, they've been trying to get those off their books and they really can't. So I think that really kind of illustrates just kind of the divide between consumer and some of these other tech and software companies that are really having to contend more with these questions about what risk does AI pose.
Great. Well, Ann, I want to thank you for coming on. That is Ann Gehan, our e-commerce reporter here at The Information. To continue our OpenAI coverage and our coverage of IPOs more broadly, I want to bring on someone who specializes in studying these new issuances. Avery Marquez is Director of Investment Strategies at Renaissance Capital. Avery, welcome to TITV. It's great to have you here.
Yeah, thank you for having me.
So you are an IPO specialist. Are you guys tracking the IPO for OpenAI just as closely as everyone else is in the tech sector right now?
Absolutely. AI is a huge theme in the IPO market right now. It has been for maybe the last couple of years, but has definitely grown in scale. And the looming OpenAI IPO is certainly on our minds right now.
Now, so we reported today on this funding round for OpenAI, $100 billion. It's nearing its final stages of coming together. They've got initial commitments from investors. The question I want to ask you to start with here is, to what extent does a funding round like this make it easier for them to delay an IPO? I mean, we've reported that it could be as soon as the fourth quarter of this year. Does this give them more leeway here? Do you see them requiring the public markets for their capital?
That's a great question. And normally I would say that a huge funding round like this could absolutely delay an IPO. But I don't think that will be the case for OpenAI for two reasons. The first being that given how much capital a company like OpenAI requires, um, tapping the public markets is going to be an eventuality. They're going to be eventually needing money from public investors, even with how generous private markets have been. And the second reason is maybe even more compelling, and that is pressure from insiders on liquidity. Private investors want to eventually, realize their return on investment, and the public market is possibly the easiest way for them to do that.
Now, what questions do you have in terms of deal structure here for OpenAI's offering, or maybe even an Anthropic offering? We've got SpaceX coming up. I mean, are there trends here in terms of deal structures, or just as you pointed out, I mean, with insiders wanting to sell, I mean, is there any particular type of deal structure that would really benefit them as these companies look to go public?
Yeah, the traditional IPO is definitely the premier way to go public. And insider selling on the IPO isn't uncommon. And I think, in fact, will probably be a theme among these very large IPOs that come to market this year. There is the question of maybe they might pursue a direct listing if they don't need the capital, but they want to give their insiders liquidity. And I think that is a fair question. But ultimately, a traditional IPO is still going to give them capital. And like I mentioned, even with all of that generous private funding, they need capital. Something that I think we'll also be watching for is dual class share structure. I think that will also be common with these larger IPOs, especially as some of the more visionary founders look to retain control even when the company is public.
Explain that for us a little bit more for people who don't know dual class share structures, what the two classes offer, which ones have voting rights. Just unpack that for us a little bit.
Sure. Yeah, a dual class share structure implies two shares, two classes. There can actually be more than that. It really just depends on the company. But ultimately, what it means is that some shares have singular voting power. You own a share, you get a vote. But what we see sometimes, especially with these very kind of visionary companies, are shares that have outsized voting power. So that might be 10 shares per vote, 20 maybe in a more extreme case. We've even seen up to 100 shares per vote, even recently with StubHub. So that allows insiders, typically founders, to retain an outsized portion of voting power, even with maybe diluted economic ownership.
Hmm. So, one of the questions I've been thinking about is, if we've been talking a little bit about the race to go public amongst these AI labs, and we had a bit of a curveball threw at us when XAI merged with SpaceX, because I think nobody really expected XAI to be the first big AI startup, or AI lab rather, to go public. And now it's very much looking like they could be, by way of this acquisition. But, we've seen some headlines out there that OpenAI and Anthropic are kind of in a bit of a race to go public. And I wondered, from your end, does it really make a difference who goes public first? I mean, uh, is there any business interest in going public first at all?
Absolutely. And it can kind of be a two-part answer. One being that you go public first, you get the buzz. You are the first major AI company to tap public markets. But on the flip side, you're also the first one exposed to that potential, slide from being in public markets. If your stock doesn't do well, that could totally disrupt the IPO market going forward. So there is, I think, a race to capture this early buzz and the early excitement that we've seen growing around AI. But there might also be, that voice in the back of their head saying, maybe it's better to let the other one go first, see how markets respond before we, put our money on the table.
I want to go back to what you were talking about with the insiders selling shares and that being a theme for some of these big issuances. I mean, educate us here a little bit on how you end up tracking that, because I know there's a lockup period. I mean, does that end up having an effect on the stock price after the lockup period expires, or how does it end up affecting the stock price ultimately?
Ultimately, in a traditional IPO, when insiders sell shares on the offering, what that means is that those shares are right. They're bought by the underwriters. They're distributed by the underwriters. So there is no initial trading by these insiders like there would be in maybe a direct listing. Um, so the impact on the share price might not be tied directly to insiders selling shares as much as it would be public investors interpreting insiders wanting to dump their shares as possibly a negative, a negative aspect.
And so, in other words, I mean, is there any way for us to know which insiders are selling their shares in the offering itself? Is that sort of where reporting comes into play, or I mean, how do you think of that as a student of this space?
Yeah, you can find that information in a company's prospectus. They might not disclose every single small shareholder. A lot of them do have tables that show every insider that is selling shares, but you certainly can see which of the major shareholders. So that's 5% or more, or any officer or director of the company. You can find that information right in the prospectus. So they do have to be forthcoming with that. And that gives public investors a leg up on that information.
Now, you've been at Renaissance for nearly 7 years now, and I wonder over that time how you've seen the balance between a company's narrative in an IPO, how that weighs with the company's fundamentals. And I'm asking the question because here we have a SpaceX IPO, for example. I mean, the narrative around uh, orbital data centers, for example, is the thing that they seem to be pushing. And now they have the AI angle with XAI. And, a lot of these companies, AI companies especially, they're burning cash, right? I mean, these are not the most um, uh, financially prudent companies, at least as far as the bottom line goes, that we've seen. And so I wonder how you've seen that balance shift over your time at Renaissance and how you expect it to change.
It really depends on the market we're in. If we are in a very strong market, public investors might be more willing to accept a played up narrative on maybe not such a match in fundamentals. Whereas in a stricter market where there's more discernment, like what we've seen really over the past few years, a narrative only goes so far. You can tell every investor that is interested that you're a tech company, you're a tech company, you're an AI company, but if your business model, if your fundamentals don't show that you're, really a tech company, you're really just a consumer company, maybe with a tech platform, um, or that your, financials don't line up with a company that should be, growing maybe 20% plus a year, and you're only growing 10. Um, Investors are much less willing to accept that narrative. Premium valuations go with premium fundamentals in much more challenging markets.
And so, with all that in mind, and also taking into context the recent performance of some of the software stocks that we've seen, I'm not asking you to predict anything about how an OpenAI or a SpaceX IPO will perform, once they do list. But how much appetite do you think there will be for these companies, and how are you thinking about the considerations that investors will make?
Mhm. That's a really good question. I think it's hard to say, but right now the appetite for AI, for a true AI play, is very strong. It is volatile. We've seen, like with the recent tech sell-off, that there are fears around AI, But a company like OpenAI or Anthropic, where AI is their business, there's no way to spin it that it's not. Um, that could definitely and very likely will definitely cause a lot of buzz, a lot of demand. These will likely be very hot deals when they do come to market.
Great. Well, Avery, I want to thank you for coming on. That is Avery Marquez, a director of investment strategies at Renaissance Capital here at here on TITV. Okay. AMD is taking a page out of Nvidia's debt playbook. The chip giant is acting as a financial backstop to Crusoe, so the AI startup could secure a big loan from Goldman Sachs. Ultimately, the deal will keep money flowing to AMD's chips. Here to explain the finer points of the deal is our AI and finance reporter, Miles Kruppa. Miles, welcome back to the show. It's great to have you here.
Thanks, Akash.
Okay, I want you to explain your story in simple terms, and I cannot promise that I'm not going to interrupt because there's a lot going on here. So we're going to wrestle with each other. We're going to try to figure it out. But tell us about how AMD is acting as a backstop for Crusoe.
Sure. So Crusoe is a cloud company. They rent out NVIDIA chips and AMD chips. In this case, they are buying a pretty large slug of AMD chips, and AMD is basically helping them do that by agreeing to rent those chips if Crusoe can't find any other customers for them. And so what this allowed Crusoe to do was go out and raise $300 million of debt from Goldman Sachs at a pretty low 6% interest rate because the bank was sort of looking through to that AMD contract and saying, okay, there's basically guaranteed usage of these chips. And so Crusoe was able to raise a good chunk of money this way. And it's very similar to something that NVIDIA has done in the past, which I'm sure we can get into more.
Now, I just want to make something clear here. So the debt that Crusoe was seeking from Goldman Sachs in the first place, that was to buy AMD chips all along?
That's right. It's to buy the AMD chips and the equipment that goes around them.
Right.
And it's also collateralized by the chips so that ultimately, if things went south, the lenders would be able to seize those chips and
Right.
sell them or do something else with them.
So basically, Crusoe is saying, "Hey, we're taking out the loan to buy the chips." AMD is saying, "We know you're taking out this loan. We're going to give you the chips, and you're going to pay us with the cash from the loan for the chips. But in the event that you can't live up to the requirements of the loan or the interest payments, we will help you rent out the chips because we know there's so much demand, and we'll use that revenue essentially to help you pay off the loan in the worst case scenario. But this is the whole backstop idea that they're helping them with."
Yeah, basically, AMD ultimately is trying to grow sales and grow usage of their chips. And, a lot of that will probably come from smaller companies. And it's kind of hard sometimes to predict where exactly that demand is going to come from. These companies are not signing 5-year take or pay contracts like some of the big cloud companies like Microsoft might be. And so, that's also part of this idea is that by AMD sort of guaranteeing the usage in the end, that allows Crusoe to feel a bit more liberty to go out and try to sell these to smaller customers that might not be the obvious big customers for these chips to start.
So where is AMD taking on risk in this equation?
Yeah, the main risk for AMD is, if Crusoe can't really find other people to rent these chips, then AMD will, be stuck with, a larger cloud bill to Crusoe than maybe it would have wanted. But, ultimately that's in service of sales. So, it is sort of uh, circular in that way. And it's even though, AMD bears some risk around the usage, they are getting to book a sale from this.
Right. More what I meant was, I mean, the way I was thinking about this was that I mean, AMD would, when you say cloud bill, just unpack that for cloud bill in what sense?
Oh, in that they would be renting these chips through Crusoe's cloud business.
Through the okay, got it. And so this is essentially, I mean, this is AMD saying, yeah, you've left us with all this extra work that we need to do. But I mean, then the fundamental question is, well, how much demand is there for AMD's chips? And I mean, that is sort of the next question: is what do we know about demand there? Is the demand as high as, we'll get to Nvidia in a second, but Nvidia's chips, everyone wants them. Do they want AMD in the same way?
Yeah, it's a great question. I think it's a little bit hard to tell, first of all, because AMD doesn't exactly break out AI chip sales from the rest of its data center category. The CEO, Lisa Su, has said she wants to reach tens of billions of dollars in revenue from AI chip sales by next year. And anecdotally, just over the past year, I think with the growth of AI and the constraints around the supply of NVIDIA chips, you have seen companies like Meta, XAI, um, turning to AMD chips, maybe not at the same scale as they're turning to NVIDIA chips, but they're at least one option in the toolkit. And of course, OpenAI also committed to using up to 6 gigawatts, which is quite a lot. 6 gigawatts of power of AMD chips over time in exchange for a pretty large stake in the company. So that's another potential source of growth for AMD.
Now, the last question I want to ask you is, with NVIDIA, we've talked about them leveraging a similar type of playbook. Do you see other companies employing this exact playbook as well? Other chip companies, other cloud companies? Where else could you see this playing out?
Yeah, I mean, one to watch obviously would be Google with what it's doing with TPUs. I could easily see the same playbook being used to help cloud companies that are renting out TPUs, like FluidStack, for instance, go out and raise debt. That's sort of the main one that comes to mind. But obviously, there are other big tech companies making their own chips. So seems like there's plenty of room to get creative here.
Great. Well, Miles, I want to thank you for coming on. That is Miles Kruppa, our AI and finance reporter here at The Information. Our next segment is with our sponsor, PwC. The enterprise software stock sell-off has everyone asking the big question, what is the future of these businesses in the era of AI? PwC has a front seat to that question as it advises some of the biggest corporations in the world who are customers of those software companies. I want to bring on Dallas Dolen, a leader at the firm's tech, media, and telco practice, to share with us what he's seeing. Dallas, welcome back to the show. It's great to have you here.
Hey, Akash, it's great to be here. Thanks for having me.
So you work with a lot of these businesses who spend all this money on enterprise software, and we've seen this software stock sell-off play out. What are the customers of these companies telling you on the ground right now?
Yeah, I mean, so first, factually, just looking at the sell-off, right? We're off about 25%, from the market highs in the fall, which is pretty significant when you look across the SaaS sector. As I've been running around and talking about this and thinking about what's the frame out, the thought that came to mind, or the phrase that came to mind, is SaaS is dead, long live SaaS. Sort of reach out to 16th century French, hierarchy changeover, and the king is dead, long live the king. I think what you're seeing is, a shift, if you will, in the marketplace, maybe a reconsideration of what the platform, critical platform dynamic is and what plays what where. In particular, the fear of agentics and how they maybe diminish or enhance, depending on how you look at it, the experience of the enterprise user and of the consumers. Right? It's not just enterprise, platforms that are being disrupted, but it's also the consumer side of it too. So what we're seeing is really a reconfiguration across the board, across front office. How are these companies thinking about selling the products? Certainly on the user side, right? With our user base, and by the way, with us even internally, as a services firm, looking at the entire just landscape and saying, hey, how do we think about all of our relationships, and what does this technology do for us, whether it's ERP or whether it's workforce management, and certainly CRM. All those are at play in terms of the number of people who will have access and what additional technologies we might be using to enhance, the value extraction from the same. So it's a real, just quantum, what additional technologies we might be using to enhance, the value extraction from the same. So it's a real, just quantum shift, if you will, in terms of the approach and the use cases that are out there. And we're finally moving beyond, and I think this is the most important part, we're finally moving beyond like the POC of AI and seeing the impact, to the day to day. And that's really where the shift is becoming most noticeable, even for me walking through the offices that I visit on a regular basis within our own organization.
So you say that you see that impact happening at your own company and also amongst clients.
Yep.
Does that mean that your clients are spending less on enterprise software then?
No, I don't think they're spending less. I think there's a recontemplation of where the money is being spent. But I'll give you this example. If you walk through the M&A floor in a number of our offices, for example, in New York at 300 Madison, you see a lot of different screens. It used to be, the research pages and the PowerPoints and the slides that were open all the time. And now you see the black coding screens, right? Using visual design or Vertex or otherwise to create the workflows that are ingesting content, using GitHub, right, to pull different application componentry in, and then of course, selecting LLMs and using the natural language, if you will, of the LLMs in order to actually interact with a lot of it. So we don't have a bunch of new coders who are hanging out in M&A, but we have people who've completely shifted the technology that they're using. So they're using all of the same stuff, right? All those same, technologies I mentioned, but then they're also using a bunch of new stuff. So I don't think you have like a complete shift, if you will, saying, oh, I'm not going to use, Office 365, or I'm not going to use, what I have with Google Workspace. I'm going to use it very differently, and I'm going to enhance my usage with this other technology.
So now, with all those tools that you see being used, I think that the question that is really scaring everyone right now is, hey, we know they're going to use the tools. Will that spend be with the existing slate of public enterprise software companies like the Salesforce, Atlassian, ServiceNow, all these big names? I mean, there's a lot of fear, we know the new tools are there. Are they going to move to startups? Are they going to stick with those big companies? How are your clients dealing with the issue of using startups tools versus the existing enterprise software tools?
Yeah, I think it's a great question. It comes down to trust, right? Like, I finally trust all of my OpenClaw to, take my kids to school and to answer all of my emails, but of course I don't, right? So I think it's a trust thing with the enterprise software, companies who we've always trusted. I don't see a complete divergence from them where people say, forget it. I don't need the most reliable platform, especially if you're in a regulated business. We're in a regulated business with everything we do in the audit and tax world, and a lot of our friends in SaaS, they supply very critical infrastructure software to regulated businesses, whether it's financial services or healthcare, and certainly in the public sector space as well. The mandate will be a high degree of auditability and reliability. You're not going to go and just say, oh, I can build an agentic, it'll take care of everything that's there. What you are going to say is, I can probably get a lot more value out of the things that I currently have with the use of this technology. One piece, and I think this is a critical mathematical, I guess, item that we haven't really solved for yet, is once you move from, inefficient to more efficient, right, on a lot of those platforms, how many people do you have that are actually using the technology, right? Which then gets into the usability and the way that they charge for the usability. Is it seat license or is it on consumption? I think a lot of these companies have already moved to consumption, right? We've seen that over the last couple of years. I mean, one of the first ones that did it was, over 10 years ago with like Adobe, for example, and their digital transformation. You're going to see that, continue to permeate throughout the ecosystem. That totally changes everything from the front office and how the salespeople at these organizations sell. It also changes how they bill. It also changes how they market the products and what they're going to embed in it, right? Especially if they can embed their own, AI and orchestration, but also how they think about partnering. And that's the most probably most critical piece here is how they think about partnering with the AI companies to ensure that you have the best ecosystem dynamic, right? Whether it's how these the NPCs work, and then also the APIs themselves, so that you have the open architecture, so that the new tech actually allows the quote older or more established platform tech to be most efficiently deployed.
So in this world here, there where the usage-based pricing ends up making up for the reduction in the number of seats, for example, that you have people using the software, which I think is sort of what these companies are saying. They're saying, you're worried about revenue declining. It's not going to decline because of the fact that we are going to implement and, really build out these usage-based models. I mean, still, the ROI then comes from, well, I'm paying people less, essentially. I have less people headcount-wise, or maybe I'm not growing as quickly. And so the thing that I've been wondering, and I'm hoping you can help me out with, is where do those cost savings then get used? I mean, sure, you could pay it out to shareholders, fine, but what will they be investing in next if it's not hiring as many people?
Yeah, well, I think it's going to be a couple things, and it's going to depend on frankly the ownership structure, and it's also going to depend on what markets it's playing in, right? So if you're taking costs out and repackaging it because you're a private equity owned enterprise, right, a software company or services company, private equity is going to benefit from that. Then of course it's going to be the shareholders of private equity. If it's a privately owned organization, that's going down and remitting back to the shareholders and the owner operators of it. I think in the public enterprise, you're going to see reinvestment in a lot of the things that they're already have been doing. And then the last one, and probably the most important one that you guys have done a fantastic job reporting on, is the deployment into capital. Right? We've seen this incredible rotation out of software margins, which we're talking about here, into hardware margins. You also then see this desire, so to say, or really maybe it's a critical feature of future relevancy, to own the infrastructure, own the GPUs, own the TPUs, and own the power, right? Savings are not going away and going straight to shareholders. I think in most cases, I think they're actually going and being reinvested in other parts of the business, both to create new products, to generate demand. So just pure demand generation, going and finding new customers globally. You still have an entire consumer group that is largely untouched in a lot of parts of the world. And then the final bit, of course, is that the most reported piece is the capital infrastructure part for so many companies that are playing in it, right? Whether you're a pure hyperscaler or a neo cloud or somebody right on the I won't say fringe, but on the edges of that. That investment base is really important because if you look out 10 years, perhaps the new form of capital, the new form of monetization of everything is not necessarily, what's the amount of quote, software license income that you have, but it's how much of the compute do you own and how much runs through your infrastructure.
So basically, it's a story where it's like a financial services company, for example, that has been able to reduce their cost base. They now have more money to spend, and they actually might look out to more vertically integrate their own tech stack and some of their own capital infrastructure in the background.
100%. I mean, I talked to a bank this week when I was out in Texas, and the input from them was, hey, like this is a great opportunity for us to like go back and reinvent ourselves. It also gives us more deployable capital to go do more investing, right? So if you're an investment bank, it's I'm saving money to go put it other places. And oh, by the way, back to the efficiency point, if I in fact am a lot more efficient in the things that I'm doing because this technology is actually better, and I think the answer to that is it is. That means I have the ability to look at a lot more deals. I also have the ability to spend more time, with the founders or with the executives of the companies I'm investing in. And that's a really big thing. We're seeing the most change in terms of mindset in private equity. In fact, we have two pieces coming out, one that launched this week and one next week on the thought leadership side about the impact of tech and private equity and how it's affecting their inputs there. My partner Alex Baker did one of them. It's going to be I think out next week. And then also the platformization dynamic, right? I think you have a lot of work on the software, companies themselves saying, hey, how do we reinvent ourselves? How do we go out there and actually, show the value that we provide, especially in those critical, spaces like the regulated companies, but also, the ability to find new customers is a real important one. And a lot of work being done by the pure SaaS players, in a search for relevancy.
Great. Well, Dallas, I want to thank you for coming on. A great conversation as always. That is Dallas Dolen, a leader in the tech media and telco practice at PwC here on TITV. That does it for today's show. A reminder, we are on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. I want to thank you all for tuning in. We really do appreciate your viewership. Make sure to subscribe to the information on YouTube, X, Instagram, TikTok, and check us out wherever you get your podcasts. I'm already excited for our next show tomorrow. Have a great rest of your Thursday. Bye-bye for now.